Hey everybody, welcome to the last batch of lectures. We've got two for tonight. Before we get started on that, just a couple of housekeeping items. This is our last week together, so be mindful any outstanding assignments that you guys have are going to be due this weekend, okay? Technically Sunday, all right, but try to get them all in by midnight on Saturday to give me time to grade, okay? Obviously, extenuating circumstances. If there's some reason you can't get them done, I'm still going to grade them as quickly as I can, but if at all possible, get them in Sunday night or Saturday night, sorry. Um, Tonight we're going to talk about how to evaluate. So, up to this point, we've been running different scenarios and setting budgets, and all this time we've been saying, and then we should use this budget to evaluate, but we haven't really talked about what that means. So tonight we're going to talk about both evaluating the individual within the company and evaluating the company itself. When we get to the company, okay, part, it's going to be a little bit painful. Okay, that's the second lecture in this deck. It is a lot of formulas. Okay, I don't expect you to memorize these formulas. I will tell you when we get to summary slides, hey, you might want to save this slide. Your slides are available under each week's module in the weekly overview. Okay, I do say, hey, save this slide. It's a good summary for a quiz or an assignment. So be mindful of that. What I want you to take away from this is what um, formula you use in what circumstance, okay? What is it telling you when you get the answer? Okay, I'm not expecting you to memorize a bunch of formulas. I don't think that does anybody any good. Okay, um, but enough about the second slide deck. Let's get on with the first one. That's this one. Okay, and talking about how we are going to evaluate the individual. Okay, so we talked about this a little bit before, how you can have um, a top-down view or a bottom-up view as far as management is concerned. Okay, um, when you decentralize management of the organization, that means you don't have upper management sort of ruling all your departments from up on high. Okay. Your top management is free to concentrate on their overall strategy. And then the lower level decisions are based on the operational departments. Okay. Lower level managers are in the trenches doing the day-to-day work, and they are more knowledgeable about what the customers need. Okay. It also allows them to gain some experience in decision making with an enterprise-wide view. Okay. Also, as we talked about last week, you get increased buy-in and motivation when you let um, other mid-level and lower level managers weigh in on how the business is run. Okay. There are some disadvantages. Okay. Obviously, um, your frontline managers are most concerned with their own division or department. Okay. They may not have a company-wide strategy. All right. There also might be lack of coordination between the different managers. Okay. And a lower level manager's objectives might not be the same as the whole organization. Okay. Also, if you want to make changes, innovation within your company, if there are, 100 different managers doing their own thing, it's really hard to get that spread across the organization. All right. Um, so also remember last week when we were talking about um, evaluations, we were talking about how you need to link the actual decision-making authority with the outcomes. Remember last week we were talking about, the cost of materials is the purchasing manager's problem, and the how much of your raw materials you use is the production manager's problem, right? But you shouldn't um, evaluate one based on what the other one is doing, right? Um, so we have this idea of responsibility centers, all right? That is a part of an organization where the manager has control over cost, profit, and or investments. Okay. So there are cost centers, there are profit centers, and there are investment centers. Okay. Um, so when you have a cost center, that's when a manager has control over the costs, but they don't generate any revenue or investments. Okay. So this is usually your service departments like accounting or administrative or legal. Um, there are standard cost variances and flexible budget variances, like we talked about, in previous lectures. And these are used to evaluate the cost center performance. How well are they controlling their costs? Okay. In a profit center, that's a segment where the manager has control over both costs and revenues. All right, but they don't have any control over the company's investments. So, for revenues, that may come from sales or interest, um, costs. There may be manufacturing costs, commissions, salaries, miscellaneous, right? In an investment center, that segment, the manager has control over costs, revenues, and investments, okay, in the operating assets. All right. So the first thing we're going to look at is return on investment, okay? This is just net operating income divided by average operating assets, okay? Um, just keep in mind that net operating income is the income before interest and tax, abbreviated EBIT, okay? Um, and then the average operating assets, that's the cash, accounts receivable, inventory, plant and equipment, and other productive assets, okay? Um, when calculating this, most companies are going to use the net book value of any depreciable assets to calculate the average. Okay. So that is your acquisition cost less any accumulated depreciation to get your net book value. Okay. So, um, DuPont Chemicals has pioneered the use of ROI. Um, And so they have sort of drilled down on all the different components. So you can, this is the traditional ROI formula here. Um, your margin um, is your net operating income over sales. This can be improved by increasing sales or reducing expenses. Okay, that will increase your margin. And then you have turnover, which is your sales over your average operating assets. Okay. Um, any extra funds tied up in operating assets push your ROI down. Okay. So, you can calculate ROI by multiplying margin times turnover. Okay. This gets you to the same place, just more steps. Okay, so here's an example. Regal Company reports the following: net operating income of 30,000, average operating assets of 200,000, sales of 500,000, operating expenses 470,000. What is Regal Company's ROI? Here is an example. They took the margin times turnover. So you just plug and chug here, okay? Um, our numbers from the previous slide, okay? And your ROI comes out to 15%, okay? If Regal's, oops, sorry. If Regal's manager invests in a $30,000 piece of equipment that increases sales by 35,000 while increasing operating expenses by 15,000, Regal Company reports the following. Right now, operating income is 50,000, operating assets 230,000, sales 535,000, and operating expenses of 485,000. Calculate the ROI. Okay, in this case, again, it's just plugging and chugging the values from the last slide. We get an ROI increase from 15% to 21.8%. Okay, in the absence of any other metric other than this ROI, okay, we don't know what's driving that number. Okay, sometimes managers inherit committed costs over which they don't really have any control. Okay. Managers evaluated on their ROI alone are likely to reject profitable investment opportunities. Okay. Um, so an alternative we can look at is residual income. Okay. This is the net operating income that an investment center earns above the minimum required return on its assets. Okay. Um, so its residual income is equal to net operating income minus your average operating assets times your minimum required rate of return. Okay. Um, how is this different from ROI? So ROI measures net operating income earned relative to the investment, okay, in average operating assets. All right. On the flip side, residual income measures net operating income earned less this minimum required return on average operating assets. So the retail division of Zephyr Inc. has average operating assets of $100,000 and is required to earn a return of 20% on these assets. So that's our minimum rate of return. Okay. Um, this is a number that we set ourselves. Maybe we used industry standards, or maybe we wanted to improve on the prior year's rate of return. Either way, this is a number we set. All right. In the current period, the division earns 30,000. So residual income, operating assets times the required rate of return, then the actual income minus this minimum required return gives us our residual income. Okay, this number, this method of assessment encourages managers to make profitable investments that would be rejected under ROI. Okay. Um, so Redmond Awnings, a division of Wrap Up Corp., has net operating income of 60,000 and average operating assets of 300,000. The required rate of return for the company is 15%. What's the division's ROI? Okay. Um, so that's going to be our NOI divided by our average operating assets, which is 20%. Okay. Again, Redmond Awnings, a division of Wrap Up, has net operating income of 60,000 and average operating assets of 300,000. If the manager of the division is evaluated based on ROI, will she want to make an investment of $100,000 that would generate Additional net operating income of 18,000 per year. Let's look at the ROI. This would lower, running through the same equation, this would lower the ROI from 20% down to 19.5%. Okay. The company's required rate of return is 15%. Would the company want the manager of the Redmond Awnings division to make an investment of 100,000 that would generate additional net operating income of 18,000? So here our ROI is 18%, okay, which is greater than our 15%. So we would go with this investment, okay? I will leave the rest of the examples for you guys to work through. But our take home message, okay, is that residual income can do a little bit better than ROI, right? But the problem with residual income is it can't be used to compare two divisions that have different sizes, okay? Because it is centered around hitting a target amount of dollars. If you have a division that does vastly larger amounts of transactions, it's impossible to compare the two. Okay, so here's an example. Recall the following information for the retail and wholesale divisions of Zephyr Inc. Okay, operating assets 100,000 compared to a million. Okay, this is the retail and wholesale division. Required rate of return 20% in each. Minimum required return 20,000 for retail, 200,000 for wholesale. Actual income. Okay, so residual income for retail was 10,000. For wholesale, it was 20,000. Okay, well, wholesale was more. Is that better? Not as good? The residual income numbers suggest that the wholesale division outperformed the retail division because its residual income is $10,000 higher, right? But the retail division earned an ROI of 30% compared to an ROI of 22% for the wholesale division. So the wholesale division's residual income is larger than the retail division simply because it's a bigger division. Okay? All right. So let's look at assessing our throughput time. Okay. So this is a delivery performance measure. Okay. So if you think of, what happens when you order from Amazon, okay, they receive the order. Some time may go by while, the sales department communicates with the warehouse or however that's done. Production is started on that item. In the case of Amazon, it would be a sales company that you're dealing with, but in the case of a manufacturing company, they would actually start building that item. Okay, so you've got your process time, inspection time, move time, and queue time. Okay, all of this, and then it goes to shipping. All right. So the period between production and shipping is the throughput time. All right. The entire cycle is the delivery cycle time. Okay. So the process time is the only value added time in this model. Okay. So in order to test your manufacturing cycle efficiency, you would divide that value added time by the manufacturing cycle time. So what portion of this entire process is value added? Okay. Here's another example. A TQM team at Narton Corp has recorded the following average times for production. Okay, wait, inspection, process, move, and queue. What is the throughput time? Remember, that's process plus inspection plus move plus queue. Okay, so this part only, the wait part does not count. All right. What is the delivery cycle time? All right, that is the wait time plus the throughput time, all of this together, right? What is the manufacturing cycle efficiency? Okay, so what portion of this is value added time? Okay, that's the process time divided by the throughput time, 1.9%. Is that good? Who knows? What does Norton Corp make? How long does it take how long does this process take? Impossible to say. Okay. So we've looked at these quick and dirty methods of evaluation. Okay. It's one formula, says it all. We're basing an entire division's evaluation on this particular formula. All right. Each one of these formulas has their pros and cons. Okay. We're going to talk now about the balanced scorecard. Also, has some pros and cons, but it's agreed that this is probably our best method. Okay. So, this is where upper management is going to translate the overall company strategy, okay, into performance measures that employees understand and have influence over. Okay. It's going to measure financial performance, internal business processes, customer satisfaction, and learning and growth. Um, you will notice, well, I'll get to that in a second. So let's look at what each of these means. Okay, learning and growth. Are we maintaining our ability to change and improve as an employee? Okay, internal business processes. Have we improved key internal business processes so that we can deliver more value to our customers? Okay. For customers, do our customers recognize that we're delivering more value? All right. Financial, has our financial performance improved? Okay. So notice that only one of these metrics is actually financially based. Okay. The balanced scorecard relies on a lot of non financial measures. The financial measures often have a lag time. Okay. So here's an example. You're the manager of a company, you come up with a new process to improve um, your company's performance. But at the time that you're releasing that new process, you're still being graded financially speaking, you're still being graded on how things were done in the prior process. Okay, there's that lag time. All right. Also, top managers are usually the ones who are responsible for financial performance overall in the company. Okay. Non-financial measures are more likely to be controlled by those lower level managers. Okay. The entire organization should have a balanced scorecard evaluation. Okay. Each individual should have a personal balanced scorecard. The personal scorecard should contain measures that can be influenced by that individual and that support the measures in the overall balanced scorecard. In other words, each evaluation metric is tied to another. Okay. Also, your balanced scorecard should have measures that are linked together in a cause and effect basis. All right. If you improve in one area, it should boost another area as well. All right. The balanced scorecard lays out concrete actions to attain desired outcomes. I know all of us have had one of those Performance metrics where they're trying to do a one size fits all scenario. Um, you know, uh, Bob is providing excellent work product on a daily basis with a limited input from management. Okay, what is excellent? All right, what work products are we talking about? How much is limited input? What does that even mean? Okay. Um, this is common, right? This is what companies try to do is come up with a one size fits all to make evaluating large groups of employees easier, right? For them. But in order to accurately assess performance and really tell people how to improve, you need to make each scorecard individualized, okay? All right. And then as a note, incentive compensation should be linked to this balanced scorecard, okay? In other words, your bonus or your raise should be tied in with how well you perform in these particular areas. All right. So we're looking at Jaguar as an example. They use this balanced scorecard method. Um, so some examples for in this particular case, they're looking at options for vehicles. So in the financial rubric, we've got profit and contribution per car. For our customer satisfaction section, we have number of cars sold and customer satisfaction with the number of options available. Internal business processes, we have the number of options available and the time to install each option. And then learning and growth, we have employee skills in installing these options. Okay, so the employees get more training. Okay, they get better at installation. They increase their skills and they get better at installing these different options. Okay, that allows more options to be available and reduces the amount of time to install those options, which makes customers happier, which causes them to buy more cars, which means we get more profit. Okay, see how all of these are connected to one another. Okay. All right, that is the end of chapter 10. I will be available bright and early Monday morning to answer questions. Okay. Um, just let me know what it is that you guys are concerned about in your last week, and I am happy to help. Okay. But in the meantime, I hope all of this was really clear.